In this video, we continue covering Chapter 4 for Principles of Accounting 1. This slide talks about transportation costs. So transportation costs can be included in the cost of purchasing inventory. Our purchase agreement specifies the shipping terms to determine when title of the good transferred to the purchaser and who pays the freight. So who is responsible for paying for the shipping costs and who owns the goods. One of the important purposes of this is because it tells you who is responsible for ensuring that the goods are okay. If the truck would crash and it's FOB shipping point, that means that the buyer is responsible because they own the goods while in transit. Where if it's FOB destination, this says that the buyer doesn't take ownership until the goods are placed in their hands. Okay, so for FOB shipping point, and FOB is a business term that refers to free on board, is what FOB stands for. So FOB shipping point means that the buyer takes ownership as soon as the goods are placed on the truck. Okay, so as soon as they go into transit, the buyer takes ownership, where FOB destination means that the buyer has to physically receive the goods before they take ownership. So this example of how we cover the shipping costs and what the journal entry is by the shipping cost. So for FOB shipping point, we take ownership at the shipping point. So the transportation costs are recorded in merchandise inventory. For FOB destination, we don't take ownership until we receive them, and then it is recorded as a delivery expense. We will practice this so you can see what that looks like. Okay. When a merchandiser is required to pay for shipping costs, we either have freight in or freight out. Okay. So freight in is the transportation cost to ship goods into the warehouse. So it's freight on purchased goods. So what freight in is that I'm Target and I buy goods from to place on my shelves. So that is freight into me. I am getting goods into my warehouse to put on my shelves to sell to customers. Freight out is when I ship things via UPS or FedEx or the US Postal Service to get them to a customer. So it's freight on goods sold to a customer. Okay, so we have this example here. We have C-Mart purchased merchandise on terms of FOB shipping point. So we took possession at the time of shipping. The transportation charge is $75. Because it's FOB shipping point and it's freight in, we record that as part of the cost of merchandising inventory. So we debit merchandise inventory for $75 and we credit cash. It's considered one of the costs of getting inventory to us to be able to sell it to customers. When we prepay the transportation costs and list as cost of the invoice. So we have this example here where we purchased $5,000 worth of goods with a freight charge of $400. We record then a debit to merchandise inventory for $5,400 and a credit to accounts payable for $5,400. So the cost of the inventory purchased allows us to, it's purchase cost of inventory minus any returns and allowances, minus purchase discount, plus any freight we had to pay to get it. One of the things that we use with the amount of our merchandise is decide how much we're going to charge for it when we sell it. So we have this example here. We have a cost of merchandise. We got a discount of $4,200. We returned $1,500 and we paid $2,300 in shipping costs. So our total net cost of merchandise purchases for this single transaction was $232, $232,400. So we have this example here. So Smart Touch Learning buys $281,750 worth of inventory. They return $61,250 of goods. They take a $4,410 early payment discount, and we paid $14,700 in freight. So what is the net cost of inventory purchase? So if we look at this, we have merchandise inventory of $281,750. We're going to subtract our returns and allowances, and we're going to subtract that early payment, and we're going to add $14,700 in shipping costs, and we get a total cost of freight of $230,790. Okay, so we have an example here. We purchased $1,000 of goods. The terms of sale are 4/10 and 30 in FOB shipping point. The invoice is dated October 1st. So looking at this, what we're going to have is, and then we paid, so on October 1st, we are going to have a debit to merchandise inventory of $1,000 and a credit to accounts payable of $1,000. On October 30th, we have cash for freight charges for the October 1st purchase. That was FOB shipping point. So we're going to debit merchandise inventory for $30 and credit cash for $30. On October 7th, we return $50 of the $1,000 of goods from the October 1st purchase, and we receive full credit. So we are going to debit accounts payable for $50 and credit merchandise inventory for $50. We now have $950 worth of inventory with the $30 cost. So our terms are 4/10, so we're going to get a 4% discount. So now when we pay on October 11th, we are going to debit accounts payable for $950. We're going to credit merchandise inventory for the amount of the discount, which is $38. And then we're going to credit cash for the difference, which is $912. So remember, when you're working on these discount transactions, that you are recording, you're making sure that your debits equal credits with all of your transactions. Okay, now let's look at this example. So on this example, we didn't make the payment in time. Okay, so with this example, we don't get the discount, and October 31st, we have to pay the full $950. We wouldn't get that $38 discount that we got in the previous slide because we didn't pay within that time. Okay, so all of those examples have been about us purchasing inventory as a retailer to get ready to sell it. Now we're going to talk about what happens when we sell inventory. So as a retailer, when we sell inventory, we get revenue. So when we record a sales transaction, we have two journal entries. The first one to record sales revenue and cash or accounts receivable, and the second entry which records that cost of goods sold and reduces our merchandise inventory by the amount sold. So we see this example, we sold 2 tablets for $1,000 cash. The tablets cost $350 each, so the total cost of the tablets was $700. First, we record the sale of inventory. We received cash and we have service or sales revenue of $1,000. But because we sold inventory, we have less inventory. So we need to remove that inventory in our records. We record a cost of goods sold for $700 and we reduce our merchandise inventory by crediting it for $700. We see another example of this. We sell 5 tablets for $500 each. So we have an accounts receivable of $2,500. We receive revenue of $2,500. The cost of those tablets was $1,750, which we debit cost of goods sold and credit merchandise inventory. One of the most common things that we forget is that when we sell inventory, we need the 2 journal entries for it. We can also offer discounts. So much like the purchases discount when we're buying supplies, we can offer discounts for people who buy on account with accounts receivable for paying us early. It's very exactly like the purchases discount, where we have terms such as 2, 10, and 30, where we have an invoice period and there's a part of that in which they can pay for a discount. What that looks like then, we see this $1,000 credit sale with terms of 2, 10, and 45. Then when we get the receipt, we receive cash, we have a sales discount, and then we reduce accounts receivable. So the buyer who bought on account from us has paid within the discount period, so they get a discount and pay us less cash. They can also return goods. So our customers can return goods. We can record the returns, so we have to decrease sales by sales returns. So here we have to estimate sales returns. So we have revenue recognition standards, that revenue recognition principle, where we can only record sales revenue in the amount that we expect to eventually realize. So we decrease our sales revenue by an estimated amount of sales returns. So if we know that 10% of everything we sell is going to be returned, then we're just going to automatically account for that in sales returns and allowances. Okay, so we have an actual return of inventory. So a previous sale, we have a customer that returned items that they bought with cash of $2,000. So we refunded them by paying them cash, and we received the inventory back. So we can return that to our inventory, and then we're going to reduce that estimated returns inventory. When we have actual inventory on hand, may differ what the books show. When we have inventory shrinkage. So inventory shrinkage is when we have a loss of inventory from theft, damage, and errors. Once a year, every business takes a physical count of inventory. So remember when I said we were going to look at perpetual inventory accounting, where we look at a computer updates our inventory every time an item is sold. Even if we are using a perpetual system where a computer updates every time, we still have to take a physical count once a year to make sure that what we have in stock and the computer match. If what we have in stock and what is in the computer don't match, then we need to make an adjusting entry to match that. So for example, we have here that we did a count and we found out that we were missing inventory. So inventory that the computer said we had, but we couldn't find in the building. Then we record a cost of debit to cost of goods sold, and we're going to credit merchandise inventory to reduce the difference. Okay. Um, Our recognition rules also require reporting of sales at net amount expected. So we have adjusting entries for sales discounts, returns, and allowances. Okay, so we had sales of $1 million and cost of goods sold of $600,000 for the period. We estimate that approximately 4% of our merchandise sold is going to be returned. So we are going to do an adjusting entry to estimate refunds coming up for the year. So we'll debit sales revenue and credit refunds payable. So what this does is this creates a payable for if people actually do return goods. Same thing, we have an estimated returns inventory, which is a reduction of cost of goods sold. Okay. Much like all revenue and expenses account, cost of goods sold is an expense account, and that must be closed at the end of the accounting period. So it's very similar to the closing process that we looked at in chapter 3, just that we also need to close cost of goods sold. That is one of the expenses that gets closed to income summary as part of the closing. Now we have what's called a multi-step income statement. So in chapter 3, we expanded on our balance sheet to talk about a classified balance sheet, and now we've expanded on our income statement, first by adding that cost of goods sold, and now we are going to divide our operating expenses into 2 categories. Okay, so we have we're going to have sales minus cost of goods sold, and then minus operating equals gross profit, and gross profit minus operating expenses equals operating income. So we're going to look at this. Wow, this graphic is terrible. I'm really sorry about that. So we have sales, we have any discounts, returns, and allowances that we've received during the year, and then we have net sales. So net sales minus our cost of goods sold equals gross profit. Here we have our expenses separated into selling expenses and general and administrative expenses. Gross profit minus operating expenses equals income from operations. We then have other gains, expenses, and losses. These are the things that kind of go after income from operations, are interest revenues and expenses, gains on sale of equipment, loss on sale of equipment, and our taxes. And then that gets us to net income. Okay. We then have a classified balance sheet where we have our accounts receivable account, and then we have a contra asset here, which is against the less allowance for sales discount. So this is recognizing that people do owe us money for accounts receivable, but if they pay us within our credit terms, they're going to get discounts. That allowances that we have estimated that everyone that currently owes us money is going to pay within the discount period. And we have our merchandise inventory and those inventory returns estimated. Okay, so that is the end of chapter 4.